Hello, friends. How are you doing? I hope that you are doing a good job in your business and your studies. And to start with, I'm going to start with working capital management. Before I go into detail the working capital aspects, I want you to know what is current asset, what is current liabilities. Okay, that's very important. You know the concept very clearly because when you take a loan from the bank or from other people, they will ask you what is the current assets you have projected, what is the current assets you are having on hand, what is the current rate you are having on hand. They will ask all the things. So before that, you should know what is current assets, what is current liabilities, because very important thing. There are two type of assets. One is the current assets and fixed assets. Again, two things are there. The other is again current liabilities on long-term liabilities. I will explain this thing to you and get used to this definition so that we can know correctly and classify correctly and get the proper advance. If you don't classify correctly, you will not get correct amount of advance from the bank or from lending institutions. And they'll give the only they'll ask you the one important ratio. What is your liquidity ratio? What's your current ratio? So in that case also, when you want to take the current liquidity ratio, you must know correctly what is current assets and where to classify, and so that you can project what is your liquidity, what is your current ratio, so that the bank loans can be advanced easily. Okay, there's no difficulty. So while I'm taking the ratio analysis, I'll explain the things concept in detail, because they will ask what is the current ratio, what is quick ratio, or liquidity, what is the liquidity you have, like that. So all the things they will ask you. So before that, we'll just go with the definition and find out what is current assets. Current assets is one which can be converted into cash within one operating cycle or 1 year. So in the next session, we'll be going to see the operating cycle. What is operating cycle? But it should normally, the operating cycle means cash to cash cycle. It should be liquidated within a period of one operating cycle or within 1 year maximum. For example, stocks. Then again, book dates. It will be converted into cash within a period of 1 year. You cannot give more than that, because not automatically when you achieve year-wise production, the stocks will come and stocks will go. Stocks will come, stocks will go. So again, book dates. So it is you are given credit to by giving the stocks to your customers. You are giving the credit. You are on credit basis. You are giving, and they will play up to 30 days or 60 days, as the case may be. So in which case, the once they pay, the cash will come. Then it will be it won't be in your books. So you won't be in your books like that. The prepaid expenses we are paid in advance, insurance. So when the due date comes, it automatically gets knocked off in the books of accounts. So it won't appear. So the current asset is one which changes its shape. It will not the same. Stock, for example, you take a stock. You want to buy a jute bag. You're producing jute bags. When you buy the raw jute, then by the time you put it in the machine and get it stitched, it changes its shape. It will not remain the same. So current assets is one which always changes its shape and converted into cash. But it's not like with the fixed assets. Building remains the same, table remains the same, AC remains the same, okay, computer remains the same. It does not change because it's fixed assets. It doesn't change its shape with which you are carrying on a business. But this is the current where it can be converted into cash within a period of one operating cycle or with a period of 1 year. So for example, stocks, book dates, this advance to suppliers. Advance to suppliers who supply, they'll demand some advance to you. So by the time you make the payment to suppliers, this advance you are given to will get adjusted. So you'll convert it into cash. So it will be knocked off from your books within a period of 1 year. 1 year means from the date of the production, from the date of purchase, 1 year. The date of production, all these things will be counting in the 1 year. It is not restricted to one financial year. From the date you purchase, from the date you produce, it will starts, the 1 year will start coming. That is why on 31st March, you will have some outstanding current assets, because you would have started the production late. So within 1 year, it will cross even March also. So it is 1 year from the date of your purchase, from the date of invoice, and from the date of sale, and all the things will count. 1 year, 1 year will count. So automatically it will get knocked off, it will get converted to cash within a period of 1 year. This is called current assets. We have financed one unit. That unit is manufacturing polyurethane bag. Polyurethane bag. So what they have done, it is a beautiful unit. If we take auto brand, the sunflower oil, all the things will be in that particular bag only. They'll bag, polyurethane bag, and they have to print it. Sunflower oil, they have to print it on the polyurethane bag. So they have the dyeing mold. So dyeing mold is given so that they can they get it printed and they dyed and etc. But thing is, the dyeing mold, the party has company has wrongly classified as current assets, which is not current assets. Why I'm saying this, it is not current assets because it remains the same. It remains the same, but it current assets will not remain the same. Okay, understood. So this is how you have to take it. You have to convert it into cash. It's a changes shape is very important. So current assets is one which can be converted into cash within a period of an operating cycle at the period of 1 year. This is all happens. So naturally, current assets is moving. It's moving. It is called circulating capital. Okay. So then again, the current liability. Current liability is one which can be payable within a period of 1 year. All short term in nature. All short term in nature. For example, you take Sunday creditors. So Sunday creditors, the people were given the goods on credit basis. Okay, on credit basis. So once you, what you do is you buy the stock, produce buy the raw material, produce the goods, sell it off, get the cash, and pay the syndicators. All will be paid off 1 year. 1 year means not exactly April to March. From the day you start buying this, count 1 year. That's why on 31st March, you will a balance sheet, you will find the pending items like syndicate, current liabilities, and current assets. It is coming. So it is paid up 1 year. So from the date of invoice, from the date of purchase. Okay. So all this because you have to put it in the machine, you have to get it in the food fixed assets for the finished goods, and then you have to sell it off, get the cash. And when you sell it on credit, book dates, your debtors will pay the cash, then you pay the creditor. So the movement is same. This is how it is taking place. So bank cash credit, bank credit also short term in nature. It is not a long term home loan. It is not like building loan. Building loan runs for 10 years, 15 years, 20 years. Then you have to go on paying EMI, but it is not the case with the short term. It is you have to bring it to credit within a period of 1 year. Bank will insist that you have to bring the period of 1 year. You have to service the interest and bring it to credit balance within a period of 1 year. So because it's short term in nature, it cannot be just to go on having a debit balance for a long time, and then bank will object to it, because what we are supposed to do, moment you sell the stock cash, you get the cash, bring it to your deposit in your cash credit account, it will show a credit balance. Then again draw it, buy the stock, okay, draw it, buy the stock, pay to creditors, get the stock, run the production, sell the goods, get the cash, go to the bank. So you see, this is a cycle. That's not a cycle. This is there's called the operating cycle. I will explain in the next chapter. Try to understand this very easy. It is nothing hard to understand. The current liability. These are the kind of bills payable. The moment you pay the bank, you pays the bill, you honor the bills, and it gets liquidated. That's all it comes. So it will not exist in your books. All will be liquidated within a period of 1 year. This is all in the business cycle. All will things. But this syndicate, you should try to differentiate between long-term liability and current liability. Current liability is short-term nature within a period of 1 year. I told you. Long-term liability, you will go on paying it. Go on paying it till it's adjusted. Because fixed assets you are creating with the long-term liabilities. Current liabilities are created or incurred to create current assets. You understand? Then plus not only current liabilities, when you put your margin, put your money, own money also. Bank will insist that you put your own money also. Where is your money? If suppose 100 rupees, you have to buy a stock. 100 rupees, you have to buy a stock. Bank will give 75 rupees, let us say. Then 25 rupees is your margin. So your margin is called net working capital. Nothing but net working. Your margin is called net working capital. What is the current assets minus current liability equal to net working capital? We call NWC. It is nothing but your own money. You have got the point? So your own money. So bank will give 75. Suppose 100 rupees stock, you have to buy it. Bank will say that I will give 75 rupees. Where is your contribution? 20 rupees you bring in. because you have a stake in your business. Everything has to be done. It cannot be done by the bank. Where is your money? Where is your contribution? Where is your stake? Bank will see to all these things. Then only you will have interest in the continued interest in your business. You should put some of your money. That's why we are asking you to bring your money. So it's like way of share capital, way of your own capital. If it's a partnership, partners have to contribute to the capital. If it's a sole trading concern, you have to bring your money. So those are so that bank runs smoothly with your money, with the bank's money. You will run the thing. So the moment current assets is created with your money and with the bank's money or with the supplier's money, the syndicators is nothing but trade credit. They are giving a credit to you. So you take the goods, or pay it after three months. What do you do? Take the goods on credit from the supplier, produce the goods, sell the goods, get the cash, pay it off. But the one thing is that this is trade credit, nothing but it is a little costlier than bank credit. Costlier than bank credit. Don't blindly avail trade credit. Justify it and do it. Okay. So they charge a little more than the bank. So you have to be very careful. Okay. So what is NWC net working capital? I will see in the next session. The funding of current assets, I will explain details. Nothing but your own money. So 100 rupees current assets you are having. 70 rupees. 75 is from the bank and the other trade credit. Balance is 25. So what is 25? 25 is your money. 25 is your money. So as your money is increasing, the stake will be more and bank will be satisfied, and because you have put your money there. So that is how they say. So current liabilities and margin are being brought in to create current assets with which you are going to carry on the business, and you get the cash flow, pay the current liabilities, get the profit. Simple, simple, simple. So you put your money, take bank credit, buy the current assets. How much you are going to have with this much? You say supposing I am going to sell, I am going to have a sales of 10 lakhs. So what a current assets will equal, let us say it is around 3 to 4 lakhs because you will have the operating cycle. So 3 to 4 lakhs. So 4 lakhs. So how much you are going to bring in? How much bank will give? Buy the stocks for 4 lakhs. The 4 lakhs consist of bank's money and your money. You got the point? The 4 lakhs current assets consist of your money and bank money. Bank will be more. Okay. Because if you have more money, why you go to bank? Okay. Why you go to friends? So like that. So now it comes there, then you put the money, run the business smoothly, sell it off, get the cash, adjust the bank. What is left out is your profit. It's a simple thing. So current assets and current liabilities, you have some idea. Then we will go to the next operating cycle. I hope you got the point, you understood. You can always write to me, you subscribe my channel, and mostly I am focusing on the small business people, because having worked in the bank, having given so many loans, from small to big loans, crores of loans I have sanctioned, like colleges, etc. So all things I have seen. So that's why I'm trying to share this. Then you'll have the other academic inputs also will be given there. Students also can be benefited. So I hope you got the point from me. Till such time, wish you all the best. Thank you.